In recent months, something highly unusual has been happening in the quiet, August halls of the world's central banks. Away from the glare of media headlines and political debates, a series of coordinated, yet unspoken, maneuvers are underway. On the surface, these are just routine adjustments to monetary policy, arcane tweaks to financial regulations. But when you piece them together, a startling picture begins to emerge, a picture that suggests the architects of our global financial system are quietly preparing for a fundamental shift. What do they know that we don't? And why do all signs seem to point to the year 2026? The current global monetary system, built on the bedrock of the U.S. dollar, has been the engine of global commerce for over half a century. It's a system that has, for all its flaws, facilitated unprecedented growth and interconnectedness. Yet, today, that very system is straining under its own weight, showing cracks that can no longer be plastered over. The first and most glaring problem is one of scale. The U.S. dollar, once the unchallenged provider of global liquidity, is now struggling to quench the thirst of a rapidly expanding, multipolar world. Emerging economies in Asia, Africa, and South America are no longer peripheral players. They are now major hubs of production and consumption. How can a system designed for a unipolar world, dominated by a single economic superpower, adequately serve a world of many poles? It's a fundamental mismatch, a square peg in a round hole. Then there is the mountain of debt. Globally, we are submerged in an ocean of credit via an unprecedented $313 trillion. This isn't just a number, it's a ticking clock. Governments, corporations, and households have all become dependent on a continuous cycle of borrowing to pay off old debts. But as interest rates have risen from historic lows, the cost of servicing this debt has become excruciating. The rollover cycle, the process of refinancing maturing debt, is getting shorter and more frantic. The burden of interest payments is no longer a footnote in a national budget. For many, it is becoming the single largest expenditure, crowding out everything else. On one hand, we are told that our economies are resilient. On the other, we see a system stretched to its absolute breaking point. Something, it seems, has to give. It's against this backdrop of systemic stress that a series of four unusual signals have emerged from central banks. Actions that are difficult to interpret as anything other than preparation. The first and most primal of these signals is the rush into gold. For years, gold was derided by modern economists as a barbarous relic. Yet, since 2022, central banks have been buying physical gold at a rate not seen since the 1950s, a period that immediately preceded a major shakeup of the global monetary order. China, Poland, Singapore, Turkey, the list of buyers is long and diverse. Why would these institutions, supposedly the champions of modern fiat currency, be hoarding the one asset that represents its complete antithesis? It's an unusual move, to say the least. Are they merely diversifying, as they publicly claim? Or are they quietly accumulating a neutral reserve asset, one that holds its value outside the promises of any single government, in anticipation of a new system where commodities play a larger role? The second signal is the construction of new financial plumbing. We've become accustomed to the SWIFT system, the dollar-dominated network that acts as the world's financial circulatory system. But quietly, in parallel, new networks are being built. Projects like mBridge, a collaboration between the central banks of China, Hong Kong, Thailand, and the UAE, are creating alternative rails for cross-border settlement that bypass the dollar entirely. Russia and Iran are linking their payment systems. India is settling oil trades in rupees. Publicly, these are framed as efforts to increase efficiency and reduce transaction costs. But could their true purpose be to create a financial plan B? A system that ensures a country cannot be cut off from global trade at the flick of a Washington-based switch? The contrast is stark. While we hear talk of global cooperation, we see the construction of financial lifeboats. Third, there's a subtle but critical shift in how central banks are managing their reserves. Traditionally, they hold long-term government bonds, like U.S. Treasuries, as their primary safe asset. However, analysts have noted a marked shift toward holding shorter-dated reserves, bills and notes that mature in a year or less. In finance, this is a classic move when you expect a major price change. Holding short-term paper reduces your risk and gives you the flexibility to reinvest your capital after a repricing event. It's the financial equivalent of moving to the sidelines before a storm hits. Are the world's largest financial institutions simply becoming more cautious? Or are they positioning themselves for a coming repricing of sovereign debt and currencies, an event they themselves may have to orchestrate? The fourth and most technical signal involves the rewriting of liquidity rules. Changes to regulations like the Basel III Endgame and new rules governing how banks value their assets might seem impossibly boring. But this is the plumbing of the system. These rule changes are recalibrating what counts as a high-quality liquid asset, effectively changing the very definition of safe money within the banking system. It's like a city quietly rezoning entire districts, changing the rules of what can be built and where, long before any new construction begins. These are not headline-grabbing events, but in the world of finance, they are seismic. They are the prelude to a new architecture. So, what is this currency reset that these signals seem to be pointing toward? The term itself conjures images of chaos, a sudden collapse of the dollar, worthless currency, and a scramble for a new global money. But the reality, according to those who study these cycles, is far less dramatic and far more technical. A reset is not the creation of a new currency. It's a reorganization of the rules that govern the existing ones. It's a conference in a quiet Swiss hotel, not a riot in the streets. It would likely involve three core components: a new diversified mix of reserve assets, where the dollar is a primary component but not the sole anchor, a framework for restructuring the impossible mountain of global debt, and a new, more technologically advanced mechanism for international settlement that is faster and more inclusive. History shows us that such resets are not an anomaly. They are a recurring feature of global finance. Every time a monetary system becomes too small or too rigid for the world it is meant to serve, it is replaced. In the late 1870s, as global trade exploded, the world shifted from a bimetallic silver and gold standard to a pure gold standard to create a more stable foundation. In 1944, with the world in ruins, the Bretton Woods Conference established the dollar-gold exchange system to finance post-war reconstruction. Then, in 1971, when the U.S. could no longer honor its promise to redeem dollars for gold, that system was unilaterally ended by President Nixon, ushering in the free-floating fiat system we have today. Each reset was a response to the old system overextending itself, buckling under the pressure of global expansion. Today, we are witnessing that same pressure building once more. This brings us to the most pressing question: why 2026? This is not a prophecy or a prediction of a specific date. It is an observation of a structural convergence, a window of time where all the pressures and incentives for a reset align. Firstly, the global debt rollover cliff is sharpest between 2025 and 2027. This is when a massive tranche of government and corporate debt will mature and need to be refinanced, likely at much higher interest rates, creating a moment of maximum financial stress. Secondly, many of the new regional settlement networks, like Mbridge, are scheduled to become fully operational by 2025 and 2026. The alternative plumbing will be in place. Thirdly, key international financial bodies, including the IMF, have review cycles for their reserve basket compositions that align with the mid-2020s. Finally, frameworks for pricing key commodities are already being renegotiated, with more and more trade being conducted in non-dollar currencies. 2026 is not a magic number. It is the pivot point where the problems become too big to ignore and the solutions become viable enough to implement. What would a reset world look like? It would not be a world without the dollar. Instead, the dollar would likely shift from being the sole global anchor to being first among equals in a basket of major currencies and, perhaps, commodities like gold. This would rebalance the system, reducing the immense pressure on the U.S. to be the sole provider of liquidity. Sovereign debt, particularly that of over-indebted nations, would need to be repriced, extended, or perhaps diluted through inflation over a long period. Regional currency blocs would strengthen, with trade becoming more localized within Europe, Asia, and the Americas. And the entire system would run on a new digital infrastructure, allowing for faster, more transparent, and more coordinated settlement between central banks. In the end, this is not a story of destruction, but one of transformation. It's a rebalancing act, the next logical phase in a cycle that has repeated throughout history. Great systems rise, they expand, they facilitate growth, and then they overextend themselves. The Roman Empire's monetary system debased itself into oblivion. The British pound sterling, which once governed world trade, gave way to the U.S. dollar after 2 world wars exhausted the empire. Now, it appears the U.S. led system is approaching its own structural limits. The eras are different, the technologies are new, but the underlying mechanism is the same. The quiet, deliberate actions of central banks today are not a sign of panic. They are a sign of pragmatism. They are the architects of the system, preparing to renovate the house before the foundation gives way entirely. The question for us is, are we paying attention? What do you think? Are these moves by central banks just routine policy, or are they a coordinated preparation for something bigger? Is a currency reset inevitable, or can the current system be saved? Let us know your thoughts in the comments below.